Hi, this is Michael Jillian, and today I'll be going over the steps that are needed in order to buy a house, and I'm going to give you some of my tips. And I looked all over the internet for someone that fully explains it, and I didn't find anything. So I'm going to try to make something that's adequate in order to explain all these steps and all these processes. So why would you want to buy a house? People do say it's the best investment after investing in yourself, but it's not always the best investment, and it's not always smart. It really depends on who you are and what you want. Here are some cons to buying a house. You now have a mortgage. You're liable and responsible to pay monthly. If you don't pay your monthly mortgage, you'll lose all your money that you spent until now on the house, and you will also lose your house. So that's not good. If you're renting, that doesn't happen. So if you miss a payment, it will lower your credit. Signing up for a loan lowers your credit. Anytime you sign up for any type of credit line, you're lowering your credit, and this is one of those things. You'll get back. You won't get back your money of closing and all the inspection costs, which I'm going to explain on the closing and inspection, all that stuff. But there's a nice amount of money you will not get back even if you sell your house. So, just keep that in mind. If you want to move, it's going to cost money to move, and you're going to have to, if you want to buy a new house, you're going to have to pay for closing costs again. You're going to have to pay for the inspection again. You're going to have to pay the agent fees again. You have to have the hassle of moving, the selling hassle. Everything is going to be very annoying. So, renting is a lot easier if you're not sure where you want to live. Anything that breaks, you're going to have to pay for repairs once you buy a house. You're going to have more space to maintain. It's going to take, longer for you to usually walk between different levels of the house. If you have kids, it's dangerous to have stairs, more dangerous than having a one floor, apartment or something like that. Your water bills are going to be higher, electric, gas, and everything else like that is going to be higher because you have a bigger house. Here are some pros. Houses go up in value. You have equity on the building. If you live there long term, you're saving money. You have a bigger place to live. Usually, these are pros of buying a house. Renting, you can leave whenever you want. You can find somewhere cheaper and just move there. You can stay by family or friends if you don't have the money and you don't have to pay anymore. If you want to move to a different location, it's usually much simpler. You just tell them, hey, I'm leaving, and you leave. If anything breaks, you're usually not liable to fix it. They'll come and they'll fix it. House stuff, at least, like windows and AC and stuff like that. You don't have insurance to deal with if something breaks, like if someone cracks a window or something. You don't have to call insurance and figure it out. Um, you just have the leasing company, the person you're renting from, come and fix it. Everything is on one level. An apartment, rooms are close to each other. Um, you have no stairs usually on an apartment. I mean, it's good for babies. It's much safer. People living under and on top of you, which is more secure than living in a house where you're more targeted because you don't necessarily have people around to see that someone's coming into your house. So that's very nice. And you may have some amenities when you're renting from your leasing company, like in a pool or a workout room or things like that, which could be better. Now, as far as condos go, condos are kind of an in between. You're paying a condo fee. Condo fees could be anywhere from $500 to $1,000. They cover water sometimes, and they cover electric sometimes. They cover Wi-Fi. They cover parking or insurance or taxes. Usually they cover taxes. So that's covered in the condo fee. That could be anywhere from $500 to $1,000, or sometimes more, depending on the condo. Um, they do a lot of the repairs depending on the condo. It's usually cheaper. The place is cheaper. Usually they're a little bit nicer too. It's usually one floor, so you don't have the problem of people, of kids falling down the stairs or anything like that. Um, they're less targeted because it's a building and it's not. There's security there also. No one's being able to just come into your house like a house. Usually they're pretty spacious and rooms are closer to each other. So those are pros and cons, and that's why it's not always best to buy a house. Sometimes the market is up, the market's down. You could be spending more on a house when you rent and you sit there for a little bit longer and then you wait for the rates to go down. You can wait for the price of the house to go down. So those are things that you could think about when you want to buy a house, thinking if it's the best option for you at this time. Now, when it comes to buying a house, I'm going to actually get into the steps you should take in order to buy a house. First and foremost, you should definitely look at your budget. Look at your bank accounts. How much money do you have? How much are you able to afford? Set aside 3 to 6 months worth of expenses for rainy day in case you lose your job or something like that. Closing costs are usually $10,000 to $20,000, so you gotta separate that also. And now the rest of your money could go towards your down payment. for your house. You can either do a 20% of the house down payment or a 5% of the house down payment or in between. And we're going to talk more about that later. And you could come back to this part and decide how much money you have. It's recommended that you look for homes that are no more than 3 to 5 times the annual household income. So keep that in mind and try to, do your measurements. Don't spend more than you have. And that's the first step is know your purchase limit. Know how much you could spend. Um, and that's even before you talk to the bank. So in the months before, you want to make sure not to spend too much money on your credit cards or on your bank accounts and have, crazy spendings. Like I'm sure that $100, $200, $300 is usually not a big deal, but when it gets into the thousands, you don't want anything fishy looking going on in your bank accounts. I would recommend that you take all your money and move it into one account that is in the name of the person that will be borrowing the money, and I'll get to that. It will make the whole process way simpler and way easier. Make sure that the account is very secure. It's holding all your money for the down payment. Have a two-step verification on it and keep it safe. Make a secure password. If you have money in a random bank account, like a random investment account or a random account, make sure that you take it out and move it to that bank account. Sometimes as soon as you want to buy, because sometimes it could take up to 3 weeks for your money to become actually available in your account. So make sure that you move that money out. You can have problems with notary, and you can have problems with signers and medallion signers and things like that. It could get complicated. So just take your money out earlier than later, so that way you shouldn't be, because once you apply for the loan, you shouldn't be moving your money around. So do it before you apply for the loan, so that way you can have your money in that account beforehand. They don't want you moving your money around when you apply for your loan. Get familiar with the wiring process in that account that you're planning on using. Make sure that your account has same-day transfers for wiring, and if it doesn't, learn how to do it in the quickest way and know how long it takes, because when you're closing, you want to know that you'll be able to transfer the money in adequate amount of time. And we'll talk more about that later. Now, before you want to buy a house, I'm assuming you want to get a loan. So pre-qualification or pre-approved for a mortgage loan basically means that you are approved for a loan even before you are looking at houses or before you even give an offer for a house. So you want to find a good mortgage lender company. I use Sam Rosenblatt. He's quick, he's great, he's to the point, and he takes good care of his customers. You will tell them your income and give some of your pay stubs, social security information, your bank information. They do a basic check on you and they run your credit. Um, if a spouse does not make money or has bad credit, put the mortgage loan just on the high credit spouse that has a job. The title of the house can still be on both spouses, but you want to have it on the one that has high credit and has a job, because there's no reason for you to put it on the other person. Once they run your credit, you'll be eligible for, depending on the mortgage company, either 90 to 120 days to create as many offers as you want. After 90 to 120 days, they need to play your credit again to generate more offers. When you are ready to make an offer, you can call them and ask them to prepare an offer for you. You may not qualify for a certain offer because a certain house doesn't fit into your financial situation. They may not approve you for that amount of money after looking at your financial situation. So how does getting a loan work? Really, unless you have cash, you need a loan. So you'll be paying back over the course of 15 or 30 years, depending what you can afford. I think you could even do a 20 or 25-year loan, but most people do either 15 or 30 year. 15 is obviously a better rate. You're going to get a better rate. So you would want to do that. I'll explain more about that later. When you get a mortgage in a house, the mortgage company basically kind of owns part of your house until you pay them back fully, which means if you don't pay, they take your house. So until you pay back, they will have a part in your house. For the same reason, you pay them, it's called PITI, P-I-T-I, monthly. What is PITI? Principal, interest, taxes, and insurance. That is your mortgage payment every month. They don't trust you to take care of taxes, and they don't trust you with insurance, and they don't want to get stuck with the fallout of missing those payments. Therefore, if your house burns down, they don't want to be left with nothing. So they make you pay for insurance, they make you pay for taxes, so that the government doesn't take away your house. Now, monthly payments um, are predetermined when you take out your loan. It only goes up and down based on property tax. Taxes go up, so the mortgage goes up, but your interest and principal will never change. Earlier payments will be mostly interest. As time goes on, you'll be paying more and more towards the principal and less of interest. Interest will go down and principal will go up until the loan is done. The formula is very complicated because the principal to pay interest on changes monthly because it's going down monthly because you're paying a little more of it monthly. Escrow means that after you purchase a house, your lender may establish an escrow account for you to pay the taxes and insurance. They basically have an account that is your money still, but they hold on to it. At the end of each year, the loaners will assess the taxes and other costs and see if they need to add to the escrow or not. Escrow is an arrangement where the bank temporarily basically holds the homeowner's funds until the loan is completely paid off, um, for taxes and insurance. Escrow is also used in a different setting. It's as a good faith gesture toward the seller to see if you're serious. You put money in an escrow account that a title lawyer holds onto, and I'll talk more about that later. The different type of escrow. What is an interest rate? It's the rate that you will put down yearly on your loan. So it will stay the same. And if you lock in a good rate earlier, that's the rate that you're going to keep. So when you lock in a rate, that's the rate that you have. So for example, a $100,000 loan at 4% means that the first year you pay around $4,000 on interest. 4% of 100 is 4,000. 100,000 is 4,000 with some principal. Remember, as you pay each month, the principal is going down to there's on less interest to pay principal on. Sorry, less principal to pay interest on. So every month there's less principal. So the second month you'll be paying interest on 99,990 instead of 100,000. Sorry, $100,000 loan at 4% over 40 years, you'll be paying. I'm just talking about the interest and the principal. You'll be paying $477.42 monthly, totaling after 30 years to $171,871. You're basically paying $71,871 of interest, um, at the end of your loan. And obviously, I'm not counting interest or taxes. Sorry, taxes or insurance. But this is all just interest and principal. So let's talk about 30-year versus 15-year. 15 will most likely give you a better interest rate and also pay off your loan much quicker because it's 15 years. You'll also inevitably be paying less interest and more monthly principal every month than a 30 loan. Now your down payment is how much you put down on the house, and the rest you're basically borrowing from the bank. So you have 20% versus 5%. The higher the percentage down, the better interest rate because the less risk it is for the bank. And it will also lessen the monthly payments, obviously, because you already paid off more. Mortgage companies and banks will not really accept less than 20% down. So how do people pay 5% instead of paying the 20% that the banks want? There's something called PMI that you are going to have to pay. It's called private mortgage insurance, and it protects the lender, not you, if you stop making the payments on your loan. And if you stop paying, the private mortgage insurance pays the bank. They're basically, you know, your insurance for the bank on you, and you have to pay for that because they're saying we're not interested in dealing with losing our money if you don't pay every month, even in the beginning, especially. If you stop paying, they're gonna lose all the money that you didn't end up paying. They're stuck with a house that they don't want. If you overpay your mortgage more than required, it will go towards the principal. Let's say an extra $10 will even go towards the principal if you pay $10 in one of the months that you're paying back. So it will shave off time if you pay extra towards your mortgage. It won't lower the monthly payments, but at the end of your mortgage, you'll instead of paying for 30 years, you'll be paying for 29 years, depending on how much you pay, obviously. So the earlier in the loan you overpay, the better. You'll be saving yourself and paying interest on the money for the 30 or 15 years that you borrowed the money for. Let's say you pay an extra $100 in your first month at a 4% rate. You'll be basically saving 4 times 30 years, 4% times 30 years. It's $120, which is pretty awesome. That's how much money you're saving. The cosigner is somebody that can come if you cannot afford payments. So the bank looks at your financial situation and say, sorry, we cannot qualify you for this account for this house. And sometimes they don't you're not qualified because they say, well, we're not counting this job that you have because you didn't have it for 2 years, or we're not counting this other thing because it's in money that's in investments. We're not counting that. We're not counting whatever it is. So you can have a family or friend co-sign and approve the loan, and instead the loan kind of goes half on them. They're co-signing on the loan. So now we're using kind of their credit in order to pay back, and they will be responsible to pay if the buyer is unable to pay. The cosigner can never be taken off the loan unless you refinance the loan. And if you refinance your loan, we'll talk about that later, you basically lose your rate. So if you have a good rate and you have to refinance, you lose it. Also, you have to pay closing costs again. We'll talk about that later. When you're actually looking for a house, here are some considerations. The location of the neighborhood, usually the most important consideration for most people. The condition of the house, if it's falling apart, if you can move into it today, depending on the person, what they need. Um, if you want to live in there long term, if an addition is possible, and if it has potential for it. Where to look for a house? The best places are usually Zillow and Redfin, but usually your best deals will come from word of mouth, your friends, looking out for signs, talking to people, having people look out for you is usually going to find you the house that you're a good deal on a house. Things that didn't hit the market yet. Now, should you use an agent or not? So here are some pros of using an agent. They'll look for the house that you want, the specifications that you want. They'll look for a house and they'll find one and show it to you. They'll help you through the whole process, make everything easier. They'll tell you what you need, what you don't need. They'll always be on your side and they'll help you with a lot of decisions you need to make. But when you use an agent, the seller must pay the agent 6% of the house total. Why does that make a difference? I'll explain that soon. Even though the seller is paying for it, it may make a difference to you, and I'll explain that soon. Not using the agent um, is better in a way because if it's on sale by the owner, then you don't have the 6% fee, and assuming there is no seller agent because he's selling it himself, so there's no 6% charge, and then you can negotiate with the seller. Say, hey, you're paying 6% less because of me, because I don't have an agent. Let's negotiate a cheaper price. Even if the seller has an agent, the agent may want to sell the house very badly, even to get 3%. And therefore, you can negotiate with the agent and the seller and say, I want a cheaper price because you don't have to pay my agent because I don't have one. So now the price should go a little bit lower. And the seller's agent may agree to it because he's just trying to sell the house if it's not something that's on the market and very hot. Otherwise, he might turn you down and say, I'll find someone else. Now, buying a house as is, that comes up sometimes. I think usually when there's an auction, the house is sold as is. Um, and let's talk about as is. If they're selling a house as is, it means they don't want to do any repairs before closing. There's no guarantee from the seller that everything is working condition. So you might go into a house and the AC just doesn't work. Obviously, you can do an inspection, and we'll talk about the inspection. But if it's being sold regularly and it's not as is, if there are things that are broken, there's more room to negotiate. They want to sell the house in working order. So technically, they can still say, we don't care, and you can back out if you want, but they may do repairs or lower the price of the house or give you some credit back. I'll explain what credit back means and how that works, but basically, you're getting the house for cheaper. Sometimes they'll leave things in the house, and you're just gonna have to take care of it. If you're out buying a house as is, they do not necessarily need to take everything out. They could just leave it, and there is a beds in there that you do not want. There's clothes in there that you do not want. You have to take care of that, and the seller is just going to leave the house as is. Um, I want to talk about auctions. Sometimes houses go on auctions. I think they go on for 1 or 2 days. Um, and you can buy a house like that. Sometimes it ends up cheaper, sometimes they're just as expensive, so it might not be worth it. Now let's talk about if you look at houses, and now that we talked about all the other things before that, you're looking at houses and you're ready to make an offer. So if you want to buy a certain house, you can offer the agent or the seller an amount. You like the house, you want the house, and you make an offer. You can make an offer just by telling them or texting them, but usually it's always better to get a pre-qualification letter on that house. And a lot of times, sellers and agents won't accept an offer unless there is a pre-qualification on your house, on your pre-qualification loan letter. So keep that in mind. You can call your loaner agent and ask them for the house and the offer amount. And if you qualify, ask them to send the letter directly to the sellers, and then your offer is in for the amount that you asked them to send in. You can always make a low ball offer, meaning that as whatever is worth it for you for that house. This house is only worth, X amount to me. You can offer that amount, and if they say no, no, you don't lose anything. But you'd be surprised how many times a seller will be willing to sell for much cheaper, or you may receive a counter offer. You can negotiate something. You could also negotiate what's included in the house. Sometimes they will say, okay, you know what? We'll leave you the freezer, we'll leave you the dining room table, we'll leave you chairs, and we'll make it a little bit more expensive. We'll make it a little bit cheaper, but we'll leave the stuff for you, or we'll sell at the same price. We'll leave the stuff for you. So when you make an offer, the lender adds in the interest rate to the contract. When you get a pre-qualification on a certain house, they send you the interest rate on your loan in your contract. This is called locking in your rate. So if your rate goes up, you are safe at the rate that you locked in, and that's important because if it's a low rate, you got a good rate. I think you may be able to change it later down the line if the rate goes down even more. You may want to change it. You can ask your um, loaner, your mortgage lender, if you can change the rate before you buy the house again. I don't know how they do it, but you might be able to. So accepting an offer. So let's say you found the house, you offered, and now they accepted it. Once your offer is accepted, you and the seller will sign a contract. It's a very basic contract that says many things. I think they're usually a little bit more generic. It says the price, the closing date, and the moving date, the seller and the buyer's names, and what's included in the house. The price depends on the inspection and that there may be repairs. They put that line into the contract. Um, if there is damage, you can back out. If you don't like the house, you'll be able to back out. That's in the contract. And if you find something that you don't like, you can back out. And and it's not going to be any problems. You're not going to lose any money. Um, you can ask them for repairs during this in the contract. The seller is liable to fix any termite problems. That's usually in a lot of contracts. Many other parameters of the seller in this contract, and you can go over it with your title lawyer, all of these things. And I would actually recommend that you go over with your title lawyer the whole contract. Um, you will also get your deposit back if there's something later that's not to your satisfaction. That is something that's in the contract. So what is your deposit? Most people, when they're buying a house after they are under contract, after the seller accepts their offer, they put $10,000 into escrow as a good faith gesture to show the seller that you're serious. This can be part of the contract, and this $10,000 will go towards your down payment. You're not losing it. If you back out, you'll most likely get it back. There's very few cases where people don't get their money back. 2 days before closing, and you decide to change your mind. You don't want the house for no good reason. Oh, you know, then and it's not the seller's fault. Then you won't get your money back, but usually you do. So you don't want to do that. So at this point, you shouldn't be shifting any significant money in your accounts. Your bank account lenders are going to ask for many statements. Nothing looking fishy should be found in any of those. This even includes transferring to and from your bank accounts. They're going to want to know, where do you send from, where do you send to, and why. The mortgage company also are going to spend a lot of time in the next few days making sure your job is real, checking all your pay stubs to determine if you're really qualified. They're also going to ask you for your bank statements, maybe even your credit card statements, anything that could possibly look fishy. They're going to look at your credit, any credit that you pulled. If you leased a car or something like that, they're going to know what it is and how much it costs or whatever, all that information. This is why I said you should put all your money into one account before you plan on buying a house, before you start looking at houses. So that way they're not going to see anything fishy. They'll just do one account, put the money, and that's it. Um, the title lawyer. You're going to need a title lawyer. Jeff Silverberg is a good guy. He's very trustworthy. He does, his company is called Esquire Title. There's a guy named Lazar. He's very quick. That's his reputation. Larry London. He has a very big firm and he's a good guy to do business with. You're going to give your title lawyer $10,000 to put in escrow. He will take care of all the title stuff. He'll be there when you close. He'll take out the loan for you and transfer the title and the deed to you. You'll give him all your money for the down payment. And he takes care of all the closing costs, all the closing stuff. And closing costs are usually 1% of the house plus many, many things that are, the title insurance, the deed, the transfer taxes, all these things could cost $10,000 to $20,000. So be prepared for that. Now, an inspection of the house is highly recommended, even though it's optional, it's highly recommended. Um, if it's not being sold as is, especially. But even if it's being sold as is, you want to learn more about your house and you want to know what's going on. It could cost in between $400 to $800 depending on who you use. If you back out, you're not getting this money back, so just keep that in mind. You're going to have it's called a general inspection, and Barry from Highland did ours. He did a really great job actually. Um, Property Pros, there's a guy named Crook. Mike Bencino, American Inspection, all names of companies that were recommended to me, but I ended up using Barry, and I recommend them highly from Highland. If they're good, they're going to test everything and tell you what needs to be replaced. They're going to check the HVAC system, the boiler water heater, the sump pump, the roof, the furnace, the radon, see if it's 4% or higher, termites, mold, lead paint, environmental stuff. They'll also check for flooding. If it's on a downhill, if the foundation is good, they'll also check for rodents, mice, and for bed bugs. They'll check the pipe. I don't think he checks the piping. They just check the outside of the piping. They don't really know what's going on the inside. But water usually doesn't go bad so quickly. The sewer does go bad, especially if you have trees by your sewer line. Wherever your sewer line is coming out, it could really ruin it, and sewer lines do need to be replaced more often than other things. So maybe you can even check that out at some point by yourself. The gas I don't know about, but Baltimore is actually replacing all the gas lines in the area, so I am not worried about that. But check your house. The inspection takes about 4 hours on a regular size house. They're also going to send a report to you in an email, and once you get the email and there's usually a lot more things on the report than that needs to be repaired. They don't most of those things don't need to be repaired. They're just things that are better off repaired or are not up to code for the modern code. But usually they're fine and there's nothing technically wrong with them. But you'll use it to negotiate a better offer and say, look at all the stuff that are broken. You need to lower lower the cost of your house, or you need to come have someone fix it, or things like that. Um, Sometimes they'll give you credit back, and sometimes they'll come and fix it themselves. If the radon levels are high, it may be in the contract that the seller may pay to install the radon fan, or you may have to, or they may just give you credit. A termite inspection, you'll have to make that separately. The inspection cost is on you usually. I paid $105, but usually the buyer has to pay for the repair. The seller has to pay for the repairs that must be done. So if the there are termite problems and the termite inspection shows a lot of termite issues, the seller will usually be doing that. Um, Usually it's in the contract from before, the contract that both of you signed. Now, once all that stuff is done, you're going to finalize the agreement. So at this point, you're going to finalize the purchase agreement. Once all the negotiations are done and either credits or repairs are done by the seller and buyer are going to sign a new contract, and the changes are going to be included in this contract. My agent told me that you could only really negotiate up to 3% of the house's value. That way, things will run smoother. The money is credited. The money that is credited will usually be credited towards the closing costs because the seller's agent wants to show that the house sold for higher. So if it's credited towards your closing costs, the house still shows the higher sold cost. Now, you're going to want to get insurance on your house. Now, this is a whole different ball game when it comes to insurance. I can make my own little video on that, but I'll give you the basics, the ones that I can remember at least. The bank requires you to get insurance on the house if you want a loan. There's a minimum coverage required for your loan, and usually it will cover basic things. Homeowners insurance generally covers unexpected damages to your house. You're going to have a deductible that could be $2,500. It could be $1,000. The higher deductible, the lower the monthly cost of your insurance is. You can schedule things such as art or any kind of art or anything like that, a gun, jewelry. Those can all be scheduled, and you could pay like $5 on a piece of jewelry a month or $10 on a piece of jewelry a month. And scheduled things um, are much easier to get insurance on, as in if they get lost or stolen or they get destroyed for whatever reason, you can call your insurance company and they'll write a check out and they make much less of problems. But if a sewage line burst or your roof caves in for no reason, a tree falls down on it, those are going to be a little bit harder. They're going to come and do investigation and stuff like that. So it's much better to schedule things that high value things that you want to cover. Now, there's also a sewage deductible, and that's usually higher than your regular deductible. So just keep that in mind. And um, Allstate has this thing. Uh, it's called protection, claim protection. That if you make a claim, then they don't make your insurance higher as long as you don't make more than one in 5 years. And the amount of money that you did not, let's say you didn't make a claim in 5 years, then they give you $100 a year towards your deductible up to 5 years. So basically $500 towards your deductible at the end of 5 years. So that's something interesting. That's all I remember to say right now, but get insurance quickly because the bank is going to require it in order to give you the loan. Now you have to have the home appraised by the lenders of the bank. Usually, you're not even going to be involved in that at all. The lenders are going to arrange for the appraisal to come and do an independent estimate of the value of your house that you're buying. The appraisal will let both parties involved know that you're paying the right price for a fair price for the home. If they find that the home is not worth the value you are paying, you're going to have to pay the difference. For example, you want to buy a house for $125,000. What is 20% of 125,000? 25,000. If you want to borrow 100,000 from the bank, because you're paying the 25,000, so you need to borrow 100, that's fine. However, the bank needs to appraise the house, and if it appraises it at $100, $100,000, so 80% that they're lending you is going to be $80,000. They're only going to lend you the $80,000, and you're going to have to pay the $20,000 difference if you want the house because they say this house is not worth 125, it's worth 100. So keep that in mind. Usually there are no problems. The bank comes in, they appraise the house, and they say, hey, it's fine, it's worth the amount. But it could be that if you specifically want that house, you're paying more for it, then they might come and say you're going to have to pay the difference because we are not approving that high of a loan on this house. Paperwork to receive final loan approval. So at this point, you're going to be doing a lot of paperwork to coordinate your loan being approved. A lot of titling work needs to be done by your title lawyer, making sure that the seller is the rightful owner and there's no other liens on the house. Repairs that need to be done, termite, radon, anything else that the seller needs to do, it's going to be done in this time. If the person getting the loan does not own one of the accounts that you sent the statement for, you're going to need a gift letter. A gift letter is um, a letter that says an account number and the gift amount, and they're going to also ask for statements on that amount. Once this letter is filled out, once you fill out a gift letter, you must send the exact amount listed from the account listed from the gift, meaning that it has to be that exact amount from that exact bank account. If it's not, there's going to be big problems. I don't know why. They're very, very intense about getting that specific amount from that specific account. Even if you find the money somewhere else, they don't care. They want the gift from the person that wrote the gift letter. So be careful that you do that. Um, that's why I said beforehand, transfer all of the money that you need to buy the house to the account that you need. And you could even avoid the gift letter by getting the person to give you a gift before you buy the house, so that way you have it. Especially if it's a spouse that's not listed on the loan, they're going to need a gift letter for that. So make sure it's in the name of the person that wants to get the loan. It will make things a lot simpler if you do it beforehand. Now you are clear to close. Clear to close means that they have verified your assets in order to close. Once the bank is ready to give a loan, that is called clear and close. The bank is ready to go. They're also going to give you a CD. Um, you and the cosigner, if there is a cosigner, get a closing disclosure called a CD, and it has to be given at least 3 days before closing. If you do not get this thing 3 days before closing, then you will not be able to get your house. You'll need to sign it or prove that you received it or whatever it is. It's paperwork of the loan and the exact amount that you owe. So this is an important amount to know because you have to send that money to your title company. So that's what it has in the closing disclosure. Now, once they clear to close, you can move all your money around and get ready to wire. If you haven't moved it all to one account already, you can move it to that account. If you have investments, move the investments out and move it all to one account. I would say also it's a good idea to have it all in one account so that way you only pay one wiring fee. Wiring costs $30, $35. You're already spending so much money on a house. Why would you want to pay a little bit more? Every penny is going to count after this, especially if you want to do any type of fixing on your house. Um, it'll also be much less hassle if it's all in one account. That way you don't have to wire 3 different times and get 3 different approvals and 3 different confirmations. Your mortgage lender is also going to send over a package of the loan documents that you need to sign at closing. He's either going to say send it the day of closing or the day before closing, but he's going to send that over. The mortgage lender is going to send that over. The papers that you're going to need to sign on the day of closing. Wiring your money. Let's talk about that a little bit because that came up and I didn't know much about it, so I'm telling you about it. If you are sending your money to a title lawyer, he will transfer all the money. So basically, what's happening is you're going to wire all the money to the title lawyer. He's going to transfer the money to the people that need it. Most of it will go to the buyer, to the seller. He's going to get most of the money, but there are taxes, title fees, transfer taxes, mortgage escrow. All those things are going to also be needed from that money, and he's going to send all that money to the right places. He'll also send you wiring instructions. Some also allow cashier's check to avoid a wiring charge, so you're getting that $25, $35 charge, um, avoiding it. Um, and you could send a cashier's check if you have all your money in one account, so that way you can wire it all in one shot. They say wire takes a few minutes. Some people say it takes less than 90 minutes. Some people say same day. Everyone says something else, but my research shows it could take up to 3 days. So it's better to be safe than sorry and wire the money a few days before closing. You have nothing to lose if you do that. I would highly recommend transferring it before, because you don't want to get messed over and push off the date. Push off the date, you're going to get a new loan. You get a new loan and you get a new rate, and you have to sign all the papers again. You don't want to do that. Um, most wires require some kind of authentication. If you are in bank, then they authenticate you there. It's much easier and quicker. Sometimes over the phone is quicker, but Bank of America and Discover don't even do phone wires. They only do either online or in store in the bank, and Discover doesn't have a bank, so they just do it online. Remember, you can only wire your money after you clear to close. You should not be wiring your money before that, because the bank wants to track it. Now, closing. What is closing? It's a settlement. It usually means you are getting the house on that day. It's usually 30 to 45 days from the offer being accepted is when you close. So the title lawyer is going to be there, and the buyer is going to be there, and the cosigner if there's a cosigner. The agent and seller may also be there, depending if you're doing the actual signing in person in the house. During coronavirus, they're doing it on Zoom, and that's fine. The agent doesn't even need to be there. The Even the title lawyer could be on Zoom, and he notarizes it over Zoom. There's going to be a lot of paperwork to go through and sign. I advise that your title lawyer go through it and explain to you everything that there is in the paperwork. You'll sign all the paperwork required to complete the purchase, including your loan documents, um, and your title lawyer is going to be your notary. He's going to sit there and make sure that you sign everything. You'll also typically get a copy of all the papers afterwards. It usually takes a couple of days for your loan to be funded after the paperwork is returned to the lender. You're going to do a final walkthrough with the seller or the seller's agent before closing. The buyer is going to need to sign a paper saying they did the walkthrough, and even the people on the deed are going to need to sign it. Make sure that at closing, everything left in the house will belong to the buyer, or at least establish what will be removed and when they're going to come take it. So if they have a bed that they want to take out, say, listen, you need to come within the first 2 days or by next week or whatever it is, because you don't want to deal with that. Once the seller gets their money, you can move in. It is prudent to record the closing and the signing, either voice recording or video recording. You need to call your electric and gas company to add the house if you want to have power in your new house. So definitely a day before or two. Maybe this should have been in an earlier part, but you need to call your electric and gas company, BGE, whatever it is, to put electric and gas. Otherwise, you'll move into a house that is cold or hot. Taxes and house assessment. So now, where after you bought the house, um, a city or county appraiser is going to come to the house and inspect the outside of your property. They usually come once every 3 years to determine property taxes. The assessment goes up every time, but by how much only determines once every 3 years. If you do renovations or buy a house like you just did, so you're buying a house, the taxes are going to most likely increase. The banker's going to come um, and they're going to increase your taxes. Now, the bank is going to see that your taxes are increased, and at the end of the year, they're going to say, okay, so we did a review on your account. The amount of taxes that we said, now since it's more, you're going to have to give us more, and they're going to make you, give $1,000 or $2,000, whatever amount that you didn't pay, or whatever it is. Usually not that much, 100, 200, whatever it is. Since you recently bought a home, okay, so the taxes are going to go up because they're saying that you paid more for the house. Usually houses go up. You paid more, so therefore you're going to have to pay more taxes. If you make a permit to do any renovations or additions, your home is going to be reassessed because it probably went up in value. They will charge you based on how much they assess the house to be. So even if you paid more for the house than what the house was being sold, they are going to come and say, hey, maybe this guy paid too much for his house. He doesn't have to pay that much taxes. You could also apply for a tax reduction based on your income. There's also something called a homestead. Homestead basically is some kind of law that they can't increase taxes by more than 4% yearly if you qualify. So that's good. They can't increase taxes by that much. Also, they will charge you a little bit less on property taxes for this homestead. I don't know if this is a Maryland, Baltimore thing, but I heard about it, so I'm telling you. Before you move in, you may want to take time to clean everywhere to make sure that you have the satisfaction of knowing everything was clean before you moved in. And if you're painting, it's much easier to paint with empty rooms. Also change all the locks and get a maintenance sheet of your house. changing the air filters, changing fans, whatever it is, anything. There's so many things that need to be maintained in a house. So make a sheet, and anything that needs to be fixed, usually it's much better to get it fixed before you move in, because that way you don't have people working in your house when you live there. After you move in, it's not a bad idea to get in touch with the person that owned the house before and ask them questions about the house. Who did their lawn, if there were any problems that you should know about, if there's any flooding, any property services that they did, and you want to use the same people, they might give you information if they're nice. Um, Now maybe after a while you want to refinance your home. This could be 5, 10, 15 years down the line, or even 2 months down the line. Um, for a variety of reasons, people get their house refinanced. What's happening is you're basically swapping out your old loan for a new one. Down the line, you can refinance your house, and there are many reasons to do this. But two main types of doing this is there are many reasons to do this, and there are two types of refinancing. Um, Rate and term refinance. This is more uncommon, but the rest of your mortgage is transformed into a new loan that has a better rate and or term for your situation. Sorry, that is the more common one. And cash out refinance is more common. You liquidate some of your home's equity, creating a new loan that consists of your previous mortgage balance plus the cash you took out. So that's basically giving you more money by, putting, uh, getting your loan back to its original state, and redoing your loan. Usually the first is what people do, and here are some reasons. The interest rate went down, so you want a better rate. You want to shake a cosigner, or you want to add someone else to the loan. You want to switch from a 30-year to 15, or a 15-year to 30, to either quicken your payments or make them less. Um, you have a better credit score, so you want a better interest rate. There is a cost every time you refinance, so don't refinance so much unless you need to. The cost is loan application, closing cost, lender fees, appraisal fees, and insurance fees. Like your original mortgage, you're gonna have all these fees when you go and refinance. I hope I was able to help you in your buying home decisions. Um, and I hope I was give you some ideas and proper steps. And have a great day.